Good morning, everybody. Today is April 5th, 2023, and back with another edition of the Wednesday Live Show. As you probably know, the market's closed on Friday for Good Friday, so it's a holiday shortened week, and volume seems a little bit low and market kind of acting kind of weird here lately, and so who knows what'll happen this week, but anyway, interesting sort of environment we're in. I thought I would start off by looking at sort of the bigger picture here. So I have my S&P daily chart like zoomed all the way out to well, as usual, starting with like the pandemic high and sell-off, the big rally, and what's transpired. Of course, last year being kind of a big down year. And then, of course, we have the beginning of the year rally here. So it's kind of interesting. Last week I drew a whole bunch of horizontal lines on the chart, and it's kind of interesting to take a big step back like this and look at some important levels here. When I look at this chart with this perspective, this looks sort of like a bottoming type of process that we're having here. Um, Purely objectively looking at the chart. Now, when I think about everything that's going on and all the problems out there and what the Fed what the Fed's been doing and inflation and all that, you kind of lean in the direction that maybe we're not out of the woods here. But anyway, huge resistance level up here. We just had basically a massive rally higher and sort of kind of running into resistance. We'll zoom in on the chart. What I wanted to do was I had a lower trend line drawn like this, right? Which clearly got broken here recently, and I thought it would be interesting to. And this is one of the things that in the past I've always done. Whether it's legitimate or not, um, a lot of times, well, obviously, let me just make a point here. If you draw a trend line, like let's take the current rally for instance, right? Like, if you draw a trend line, well, let's see here, see if I can illustrate this point. Yeah, if you draw a trend line like that, I mean, obviously it's gonna get broken. It's just too steep, right? If the market just trades sideways, it's going to just break through the trend line. So I've always said that the steeper a trend line is, kind of the less sort of valid that it is, and especially if they're ridiculously steep. Now that doesn't mean on an extremely short-term basis that drawing a trend line across these lows straight up isn't valid. But anyway, for the purpose of this, I just wanted to zoom way back out and sort of draw that lower trend line across these more recent lows, right? Which I guess you could call the banking crisis lows, because that's basically what was happening there when we had that sell-off. So it's a bigger picture sort of thing. I guess the main point is that we're kind of in the upper end of the range, and there's tons of resistance up here overhead. And this most recent rally, that's funny when I zoomed out on that. Let me see if I can. There we go. I need to fix this a little bit. And you could even cut that little low off, but this was a pretty significant rally here from 3,800 up here to over 4,100. And so it kind of looks like it's running out of steam a little bit. Thing is that April typically is seasonally kind of strong. So we've got this holiday week here. It may start off a little weak, but there's every possibility that it does a little bit more work up here. Really kind of, a lot depends on the news cycle, I think. So 4,200, sort of the big upper end of the range in the big scheme of things, because that was this highest high back over here. So um, anyhow, this is kind of an interesting pattern here. Kind of an interesting pattern because coupled with, and it looks a little bit different now that I've drawn these trend lines on here, but it's kind of a bottoming looking pattern. Whoops, didn't mean to do that. And so we'll just have to see what happens. If I take these lines off the chart, if I just get rid of them, if I get rid of these lines, just sort of zoom in here. There we go. There we go. This is what I'm looking for. We have like these zigs and these zags, right? And so, we had a we had a big consolidation back around the holidays last year, and then that run up to 4,200, and then a pretty significant sell-off back down to 3,800. And so, like right over here around 3,900. Remember I talked about this last week. We were kind of right in the middle of the big, the big giant range. And so I guess I should have probably just left that on here. But 4,200 is like the big spot, and you can see it goes back to back to over here too. It was kind of an important level back last fall because the market sort of sold off, and like that's kind of where the big sell-off started from, right? You can see a gap down, and then so 40, we can all sort of agree that 4,200 is like the big giant overhead resistance level to beat. So a couple other interesting things is that the S&P spent most of the time below the 200-day moving average, and now of course it's above it, and the 50 crossed above the 200 and all this kind of stuff. But it seems like we're kind of set up after this really sort of massive rally, and these last few days of March were what some people called end of quarter window dressing, right? Which kind of makes sense, but it was a massive rally, a little over 100 points there in 3 days, and so now some give back sort of seems reasonable. It'll be interesting to see what news kind of coincides with this little interim top here. So the next question is like how far down do we pull back? And it may not be a straight line, right? The market likes to have these up down days, and it could potentially consolidate here. Well, let's see. There's only today and tomorrow, right, left for this week. So let's go to see what the weekly chart looks like here real quick. Big overhead resistance line. It seems even a little bit more clear on the weekly chart. So kind of looks like we're set up for a pullback a little bit further down into here. And so whether this is going to morph into a down cycle over the next few weeks into April remains to be seen, right? It's just sort of based on what the market has done in the past. It has the zig and then the zag, and then the zig and then the zag. Here's an interesting chart is Apple, right? And I'll tell you why, because Apple's got like this big sort of channel going on here. And of course, Apple is obviously the big bellwether for the whole market, and so this is an extremely interesting chart because whatever Apple decides to do from here, it's likely to, that's going to affect the market a lot. And I'm sure that you've seen this statistic. There was a statistic that I see floating around the internet the past couple weeks. It says something to the effect of the I think it's like the 8 largest cap stocks. You know, your Apple, Microsoft, um, Google, Amazon, I guess, Exxon. Well, I don't know if Exxon Mobil, but anyways, the 8 largest stocks have accounted for, you know, almost all of almost all of the rally that we've seen since, you know, over the past month or so, few weeks, which is kind of interesting. And so this is, you know, this to me is one of the more interesting charts out there right now because you can see that Apple's in like this big giant channel, and this is a weekly chart too, right? And so I mean, look at look at this week's candle so far. Excuse me, choking on my coffee. Compared to the last one here, there's a little similarity there. Now, of course, you know we got a couple days left of the week, so we don't know. We obviously don't know what it's going to look like when it closes, but we do know that it's run straight up to the top of, or near the top of the channel anyway, and you know, you had a run up to the top of the channel and then a lot of volatility test, but you had to run straight down to the bottom, straight back up to the top, down to the bottom, up to the top. And so this, I think, is going to be one of the most important things to watch going forward. And if Apple decides to take another trip back down, you know, to the middle or the bottom of the channel, then this market is going to, you know, go back to the S&P. Then this market is going to take another trip back down here to perhaps, you know, perhaps down around that area, right? Or at least below 4,000. So, well, this is the weekly chart. So, so that's it. Anyways, that's going to be really interesting. Now, there's a few things that I wanted to look at real quick. Let's look at the small caps, right? The small caps in the Russell 2000, and this is another sort of thing that's unusual, is, you know, the other day we had a pretty big sell-off in the Nasdaq at the same time that the Dow was, you know, up a few hundred points. And so every time that happens, whenever the markets kind of don't trade in tandem and they all seem to like disconnect, it always reminds me of, you know, 1999, 2000. Actually, it was like the late 90s, especially like 1999, the dot-com thing, right before the dot-com implosion started. There was like this really weird sort of divergence where, and I remember this pretty well, where the Nasdaq and the Dow literally moved in opposite directions on a day-to-day basis, right? It was just kind of strange, and I'll never forget that because it was seemed like such an anomaly based on, you know, the construction of the indexes, but it just seemed like such a strange environment when you had the Dow was up big one day and the Nasdaq was down big, and then a couple days later the Nasdaq would be up big and the Dow would be down. And so that kind of, and my point here, looking at the Russell 2000, is that it's not necessarily an extremely healthy market environment. Obviously, based on the idea that a handful of mega cap stocks are contributing, you know, primarily to the recent rally. It's a narrow market. You know, back in the 70s, which I don't remember, but they had something called the Nifty 50, right? And so it was like there was like 50 stocks that, you know, that were holding everything up and doing great, and the whole market was based on, you know, those 50 stocks. Well, now it's like the Nifty 10 or whatever you'd want to call it, but it's the same concept that a handful of stocks are attributing, and you can, that's well illustrated by looking at the Russell 2000 here, which is, you know, 2,000 stocks compared to the Dow 30 or the Nasdaq 100 or whatever. But anyway, these smaller stocks are not looking so good, right? I mean, here's the, you know, there's kind of a double bottom here at the lows. But you can see that instead of the small stocks like being up here, right? The, you know, the S&P is like this. Like this is kind of where the S&P is here. It had this run up, and so it's up here. But look at the Russell 2000. So this is kind of a caution sign, I should say, because it's basically, and boy, if the Russell 2000 loses, this level here, then look out, because next stop is down around these lows. And obviously that's, there's a lot more to it than I'm sure that could be explained and rationalized and all that type of thing. But this is one sort of nasty looking chart here. So to me, this is a caution flag. Might as well look around to prove my point here. The NASDAQ. So, the S&P is battling with, it's not quite reached this prior high here. So the S&P is still stuck over here and looking like it wants to turn down below this prior high, whereas the NASDAQ has actually broken above that prior high, made another high, and so that's kind of interesting. So let me just extend this line back here. So, it kind of ran into the same resistance point, right? Interestingly enough, this little spot right here, like when we looked at the S&P a couple minutes ago, that little spot right there was S&P 4200, where you had that gap down, and then it tried to bounce, and then that big long range down day, which kicked off, the move to the actual lows. And so the NASDAQ 100, I should say, managed to rally all the way up to that level, and it's still hanging on. I mean, just because right now it's kind of looking a little shaky or whatever, doesn't necessarily mean that it can't continue the inertia of this rally. And so there's another spot up here. So it'll be interesting to see what happens. And of course, everybody knows that what the Fed what the Fed says and what they do, in my experience, has been two different things. What they say and what they do a lot of times turn out to be two different things, but what they're saying is that they're going to continue to hike rates and until inflation comes down, right? And so that's and they're going to raise rates to around 5%, and they're going to hold them there until inflation's around 2%. And the crazy thing is that the market itself now, and I think I just saw this morning, that the market is pricing in a pause in May, that they're not going to raise rates, they're going to pause, and they're basically not going to raise rates in June, and then they're going to start cutting rates. And so quite frankly, I don't know that much about all that stuff, and I couldn't tell you why or how that's calculated, but it has something to do with, the bond market and the yield curves and all that good stuff. So the market, in theory, the market is pricing in, a pause and a pivot, and the Fed is saying that they're not ready to pause, and that they haven't even thought about a pivot, because all these Fed talking heads multiple times have said that they're going to hold interest rates, at the higher levels all throughout this year. So, which brings us to the next thing to look at, which is the banking indexes here, especially like the smaller banks, right? There's KBE and KRE. KRE is regional banks, and KBE is the Spider S&P Bank ETF. But here's the thing to note is we had this banking crisis, and then of course the Fed and Treasury and all that extraordinary measures and backstopped everything and this and that. And so when we looked at the S&P chart, that was kind of that sell-off, and then we've rallied since then. But the interesting thing to me is that looking at these banking indexes and looking around at a bunch of banks, it doesn't look to me like the problems have been solved, right? If the if the problems in the banks and the smaller banks and all that had been solved, well then these indexes or these ETFs would have rallied back, at least rallied back a little bit, and here they are like sort of plumbing the lows here, right? So this is another sort of caution flag. I mean, look at KRE. Even today, it's like it's making a low since the bank panic back here. This was the bank panic. I mean, here we are right down there at the same lows. And so, it was interesting that Charles Schwab got sort of caught up in that. And quite frankly, I don't even know why, or I couldn't tell you why Schwab was sort of caught up in that thing. But look at that 3-day sell-off. And then look at where it is now, which is this is a little bit concerning. Let's see, there was a few other ones. I don't, off the top of my head, I don't know. I don't follow many regional smaller banks, or, well, when I say smaller, I mean some of them aren't small, but I don't really follow the smaller banks. But when I look at a few of these charts off the top of my head, it looks to me like the problems are still there. At least, that's what the stocks are reflecting. so that's sort of well, there's a crazy chart. Jeez. Anyway, that was my point, is that if you look at the XLF, which is, this is going to incorporate the mega banks here, right? We all know the too big to fail banks. It's still a pretty ugly chart. And a little bit of a bounce back, but still an ugly chart. There's a screen over at FinViz where you can just pull up smaller regional banks, and then basically what you get is is a list of, you get all the charts of the banks that make up KRA and KBE, and they're a mess. I mean, they all still look like this. And so just kind of, it makes me wonder if there's like a second shoe to drop, so to speak. But then I've also seen articles that say, hey, hundreds of banks fail all the time and you never hear about it, and this and that. So we'll just have to see. As far as the Dow goes, I suppose, hang on, let's look at INDU. That's the actual Dow. The Dow is kind of in its own world because the chart of the Dow always looks so much different than everything else, just because of the fact that it's 30 stocks and the constituents and all that. And then, of course, we had a day, I guess it was Monday. So, you heard all the news about OPEC. OPEC Plus is cutting oil production, and so that's gonna, cause oil prices to go back into the 80s there, and that's going to have a big effect on inflation, in theory, if oil stays. And I haven't looked to see what oil's trading at today, but the idea, there's so many pieces to the puzzle and so many cross currents right now going on. But anyway, what my point was that when we came in on Monday morning to the office, OPEC had cut production, and so that caused oil to spike up to I think it was $82 or something like that, and that puts them it's at 80. It's a little over 80 right now. I just saw it on CNBC. That's going to throw a monkey wrench into the Fed getting inflation back down to 2% in theory. But my point about this chart was that ExxonMobil, being in the Dow, was up significantly on Monday, while the other indexes, like I said, the NASDAQ was taking a hit. So there's always that to consider. Yeah, this is a pretty crazy chart. I mean, it almost seems like the zigs and the zags are are more pronounced on the Dow. And the Dow's, at this point is quite a bit more off the lows than the other indexes. And quite frankly, if this was an individual stock and I didn't know the name of it or anything about it, I would say if it's able to bust above this trend line and get above, here, then it looks like, it's primed for new highs. So speaking of which, all of a sudden, and this is another, let's look at a weekly chart of gold, right? All of a sudden, look at that. So GLD, the gold ETF, looks like it started back here in 2005, which is kind of interesting. And man, look at that chart. I mean, this is a weekly chart going back to the inception of GLD ETF. But look at that move from inception to yeah, well, I guess that was 7-8 years there. But anyway, a lot of people are talking about this long-term big giant cup and handle. If this breaks out, and of course everybody's heard about all these other countries now are starting to move away from the dollar, and some people are taking that seriously. It's a longer term trend type of thing, but anyway, if you look at this chart, I mean, gold is really, really super close. And here's the other thing too, is like actual, the price of spot gold, which I don't know if. Oh well, there you go. Well, this is even obviously this is a much better chart to look at than. I just wasn't sure what the symbol was. This is obviously it looks similar to the GLD ETF, but this just shows you that gold's near an all-time high in the history of U.S. dollars. See, that's the other thing about this. This is very interesting. Okay, so look at that. This data goes back to 1970. Wow, that's pretty amazing. Pretty amazing. And so, I mean, people have heard stories about the gold bull market of 1980 or whatever, right? And that was back when inflation was going crazy and all that stuff in the late 70s, and yeah, so this is pretty interesting. The most interesting thing about it being that gold is within spitting distance of the all-time high in the history of the US dollar, or I should say the Federal Reserve note. So, and I see now that people are using technical analysis. People are saying, okay, this is a big giant cup and handle. This is a monthly chart we're looking at, and then if it breaks out of this, it projects to whatever. So it should be really super interesting. What I see on this chart, kind of, my eyes are like trained to spot these little. Over the years, I always look for things that look kind of similar, and so it's like these kind of three little spike ups here. That little spike up, and these three, and this little sort of divot here. Just move down and back up to that spike. I mean, kind of looks like this, and so anyways, I mean, there's a little bit of a similarity between this area here. I mean, we're talking years here, right? Because this is monthly, and so there's a similarity between this area and this area here, and you can see once it broke out, I mean, it broke out huge, and I'm sure everybody got, crazy excited and chased it and all this, and then, it spent months pulling back to sort of here, but the subsequent move was significant. I mean, it basically doubled once it broke out of that particular pattern there. And so that's just something to keep an eye on, right? Because the thing of it is that there's so little market cap I believe, in actual gold. And of course, over the years you've been hearing about all these countries accumulating it, and Russia and China and all that, or accumulating gold and moving away from the dollar. So anyway, there's a lot of potential here, but it's nice to look at these monthly charts because that gives you a little perspective that you can spend months like doing sort of nothing, and then things happen quickly, right? And I mean months and months and months go by, and so like focusing on what gold does on a day-to-day basis is completely pointless. If it breaks out here and hits a high, takes out this high like it did there, the potential exists over, the next X amount of years that you could get a pretty significant rally just because it's a similar setup to back here. And so that's basically the point I wanted to make. And then, of course, silver, I don't even know what the ticker symbol would be. I don't know if they have it, to be honest with you. Well, look, they have the silver contract here. So go to a weekly here. Same sort of thing happening with silver. It's got kind of, it's a lot more of a weird thing. Oh, this is what I wanted to look at. Since I just realized that stock charts here has this data for like gold and silver going back to 1970. So look at that. There's where that must be the infamous Hunt brothers tried to corner the silver market. That's amazing because I mean imagine what almost $50 silver was like back in 1980 dollars. Right? I mean the thing, how much how much has the purchasing power of the dollar eroded since 1980? So, well, you could look that up. There's a CPI calculator online where you could say, $50 in 1980 is probably, $150 today. So, anyway, pretty crazy stuff. And then of course, I mean, I remember this move back here back in, what was it, like 2011 or something, 2012? Yeah, 2011 when silver like had that massive run up. I honestly don't remember what that was all about, but it's set up in a pretty bullish little bull flag there, all that type of thing. And so I'm guessing that thing about silver being an industrial commodity is literally in every electronic, and so quite frankly it's surprising that it's this low based on the loss of purchasing power in the dollar anyway. So silver could potentially be a really good long-term investment from here because it seems like it's been held artificially low. And again, there's so many pieces to the puzzle, but I don't think electronics are going away, right? If anything, electronics more prevalent, and the cost to get it out of the ground. And so, you can dig into like how much is produced and how much is used and how much scrap silver there is and all that type of stuff. And then there's the gold silver ratio, right? Which is kind of unusual. See, if this was a complete anomaly, if that run up was an anomaly and you just cut that off. Well, you just cut that off at like say $25. Like if you pretend that never happened, and silver was like here and then here and that type of thing, it still seems low. So watch for an actual break over 25 for spot silver. A little bit more, and this just kind of shows me that the potential always exists for like a super explosive move. The other interesting thing is that, this little spot back here, which we were just looking at in gold, right? We were just looking at like that same little sort of setup. It looks different on silver. It looks much different. I guess you still sort of have those, those peaks or whatever and the little scoop, but anyway, real interesting to see. And I I read a long time ago that I read this in some gold article years ago, and it always sort of stuck with me, is that Mother Nature sets the gold-silver ratio based on the idea that there's 60 ounces of silver in the ground for every ounce of gold that that these companies that mine for it, and I don't know if that's the exact figure, but the concept was most interesting. Is it based on based on companies that excavate gold and silver from the ground? There's a ratio of how much, roughly 60 to 1. And so take a look at the gold silver ratio where it stands now. And there's always the idea that if that mean reverts, then the potential exists for my point is that silver should probably be considerably higher than it is just based on that. But anyway, so as far as oh, by the way, you guys want to take a look at, and I'm sure you saw this, logged into the site and took a look at the note that I have on the home page there. And so that's something kind of important, because one of the stocks that we had on the pending list is likely to trigger in here within the next couple of days. So just take a look at that. But anyway, so it is what it is here as far as the S&P goes. Interestingly enough, I left my chart on the monthly, and so those the trend lines that I drew, are still kind of valid. So there's the recent high, there's the little sort of uptrend line we're working with, and then here we are. And of course, yeah, we're right at the beginning of the month, so there's no reason to assume anything about the monthly chart, other than the fact that based on monthly ranges, it's very likely that we're either going to poke above here or we're going to retrace back down towards here. So that's kind of interesting. I mean, the longer term charts, I really, at the end of the month, I really look and sort of visualize what I'm seeing on the monthly chart. One thing to note on the monthly chart, so go back to, there's the top of the bull market, right? There's the February low, and I'm gonna draw this line. It's almost hard to illustrate my point with a thick line like this. Let me make it real thin, because that February low, look at the closes of April and May. Look at the open of June. Look at the close of July. Look at the open sitting right on the line there. Look at that high. Look at these 2 months right there. Look at this high. And so, this particular level right here is that particular level, which is basically 4,100, is kind of the big kahuna over and under, and keep in mind, we're looking at a monthly chart here, and look at how the closes and the highs and all this price action are sort of, ever since going all the way back to February, when Russia invaded Ukraine, right? The low there. And this was pretty amazing. Like April and May, for the close of April, the open and the close of May, and the open of June were all like right there. Just amazing. Just amazing to see. And so look at where we are now. I mean, we're just a little bit ago, we were still right in that same spot. So that is, I guess you could call it like some sort of, really weird equilibrium zone. Because, I mean, here we are, like, 14 months later or so? And we're like still kind of, that spot is still extremely relevant. We're just barely, pulled back from being right there again. So keep that in mind. Anyway, thanks for tuning in. I will see you guys back here next week.